Okay, so today is the 7th of January, and it's a whole new year. So obviously, the beginning of the year means the beginning of tax season, and that is a whole thing. So just today, Serena, you and I were talking with a software provider for one of our internal tools, and we were talking about like how to streamline things and little upgrades we can do. So hopefully, this season will be the smoothest season that we've had to date. That's always the goal. And I'm optimistic. So the office I'm in is the new office, obviously. This is something I haven't had since 2000, as the whole world shut down, and I've been working out of the basement since then. It'll be interesting to see people face to face once again. Obviously, most of our people are remote. In fact, I talked to somebody came in the office on Monday, and we sat down and we went over their situation, everything. And they just wanted to get the lay of the land as far as how we're going to operate this year. And I said, yeah, you don't need an appointment to drop off paperwork, but if you want to have a sit down, that does require an appointment. And this says, oh no, we'll just upload stuff. Okay, all right. So they're local enough to come once a year, but not local enough to drop off enough. A little bit of a hike there, but that's okay. Yeah, let's go ahead and get started. Let me make sure this is actually working. And that guy. Okay, so the $1 trillion show. That is what we do. And why is it called the $1 trillion show? Because the mission is to save Americans $1 trillion. It's funny, on X, a few days ago, Chamath from Polyhabatia, I think is how you say his last name. He's one of the hosts of the All In podcast. So he's a Facebook early employee, made billions of dollars and whatnot. Now he's a VC guy. And he posted a question that says, okay, if we could cut government spending, then what would taxes have to be in order for that to work? And I actually did some math on this. So basically, federal government spending, states are their own issue, but federal government spending is composed of a few major categories. So one is Social Security spending, second is Medicare, third is military, and then there's discretionary everything else. And that's going to include all the things you hear about, like the Department of Education, the Department of Agriculture, the Department of this, that, and the other. When you see news stories about how the government is funding some study to research some ridiculous thing, that's all discretionary stuff. In fact, the military budget itself is discretionary, although in reality it's not. And then there's interest on the debt. So I went into ChatGPT and I said, okay, let's do some projections. Let's cut Medicare spending by 1/3. And the idea there would be to find operational efficiencies within the Medicare agency, renegotiate contracts, all this kind of stuff. So that a third, I think, could be possibly done. Social Security is going to remain the same, no cuts at all. Defense spending cut by half. And that is certainly possible because there's enormous amounts of money that goes into black holes that nobody knows anything about. Nobody can trace the money. Nobody knows what it's spent on. Perfectly possible to cut military spending by half. And in fact, I think even if you did cut US military spending by half, I think it would still be the most in the world. There's that. And then cutting the discretionary stuff by half as well, because there's so much ridiculous waste there. And then keeping interest on the debt the same. So those 5 categories with those 5 adjustments, again, no adjustment to Social Security, what would the total spending be? And the answer came out to $3.4 trillion. Now, last year, the federal receipts from taxes was 4.3 trillion. So if the government were to leave taxes the same, bring in 4.3 trillion and spend 3.4, that leaves 900 billion of surplus rather than the 1.8 trillion of deficit. So it could work. Will it work? Probably not. But that would be a way to save $1 trillion. Instead, we play our side of the game where instead of having the government cut spending and do that voluntarily, we starve them by reducing their input. So instead of 4.3 trillion, we bring them 3.3 trillion. And that way they end up being forced by market pressures to reduce spending. So that's the mission. That's what we plan to do. And the way we do that is what happened to my thing, is by scaling tax saving strategies through technology. Obviously, we have our own clients and we do client services and we do a lot of good for our clients. However, that's not going to get us to $1 trillion. And we can't do everybody in the US's taxes. But what we can do is make tools available to everybody in the US pretty easily. And if people are able to adopt those technologies, apply those strategies that work for so many people, and just do that en masse, then we can start to achieve these huge tax savings and starving the federal government of money. Now, the net result is you'll also have similar effects on the state governments. That's more varied because there's 50 different states rather than the one federal, but it all flows together. Most states will follow the same kind of pathway. All right, so who am I? I'm Neal. On the call with me here, Serena and Fatma. Serena's our ops manager, Fatma's our admin. I got into the whole tax game and became chief tax strategist because of my own tax problems. So back in my 20s, I was doing all kinds of this, that, and the other, trying to find my way in the world as an entrepreneur. And I started getting letters from the IRS saying I owed them $1.3 million. It was actually over 1.3. And like most people who get a letter from the IRS, I stuck my head in the sand and I ignored it. So I went through that whole process. First, you get letters, and then you get certified mail, and then you get phone calls. And then if you ignore all that, and the number is big enough, like it's 7 figures, then they will start going after whatever they can find. And in my case, all I had was a paycheck. I didn't have any significant amounts in a bank account. I didn't have any cars. I didn't have any boats. I didn't have any houses. It was a low point at the time. And so they started garnishing my paycheck. And then I couldn't afford to, eat. So I had to start fixing my problem. And that's how I got into the whole tax world. And I ended up, the guy who helped fix my problems ended up becoming my mentor and was a former Wall Street tax attorney. And there was a whole eye-opening experience of learning the insides of high-end tax planning, which is not what most tax preparers do. That's the origin. And then in 2019, started Tax Sherpa. And then really made a go of it in 2020. And then obviously COVID happened. Been working out of the basement since then, and now bought somebody locally bought his practice and now have an office. That's who I am, where I come from, where Tax Sherpa comes from. And obviously Serena and Fatma are part of my staff that help us get everything done. Yep. All right. So that's the who, that's the why, is to save $1 trillion. The what, there's many whats. We released a starter course, and this is like the basics of tax planning. And I'll show you how to get the starter course later on. What it does is it steps you through the basic building blocks of a tax plan that works for just about everybody, if you want it to. And I've had conversations with people with this practice that we just acquired, and we go through situations that you could do this, you could do that, you could do the other thing, and some people just don't want to, and that's okay. You gotta do what's right for you. But if you want to save money on taxes, then this is a great way to do it. In fact, the people I talked to yesterday who were in the office here, we were just going over the situation, and it was a husband and wife, and the wife sells, she's a weaver. She makes scarves and blankets and stuff. She bought a big loom last year, apparently. And so we were talking about how to treat all this from a tax perspective. And I said, okay, the way you are set up right now, you'll do it this way. If you want to maximize your tax savings, you do it this way. And I gave her the rundown of the starter course, of what's in the starter course. And they were like, yeah, I don't know. I want to keep it simple. I was like, okay, in your case, it's worth $7,000 to you. I know, maybe these are the kind of decisions that everybody has to make. But I want you to at least know your options. And if you choose to employ tax strategies, great. If you don't, that's okay too. We can still be friends. But I personally think it's better for people to keep more money in their pocket and less paid to the government. That's my position, and I'm sticking to it. All right, that's who we are. That's what we do. For the next 45 minutes or so, we have questions. Anytime we talk about taxes, there's always loads of questions. We like to take the time here to go through those. And I have the answer to every tax question. Every single one in the world that you've ever had, that anybody's ever had. The answer is, it depends.
It depends.
And people think it's like a trite kind of answer, but it really is. It depends. And it depends on what we call the facts and circumstances of the situation. What is true for one person is not going to be true for another person. For example, I've talked to a few people who are retired, and some of them give to charity. I've talked to them about the qualified charitable distribution. And that's where If you're over 70 or 72 and you are required to take distributions from an IRA, for example, there's a certain amount you have to take every year. It's called the required minimum distribution. And the whoever runs your IRA will just give you a number and say, hey, we're paying you this, whether you like it or not. And that becomes taxable income, right? Because the deal with traditional IRAs and 401ks is when you put the money in, you got a tax break back then. But on the backside, you have to pick up the income and pay taxes late. So for some people who are retired, it's now later. And you have to do that. For people who are charitably minded, there's a workaround, right? So there's the qualified charitable distribution. And this is where instead of you receiving the money from your IRA, the money goes straight to a charity. But it still counts towards your required minimums. So let's say, just picking numbers, the RMD, the required minimum distribution for the year is $10,000. I want to give $3,000 to my church. Okay. And so I only have to take personally 7,000, that difference between the 3 and the 10. And that's more efficient from a tax perspective for charitable giving rather than taking the full 10 and giving 3. And the reason it's more efficient is because of the thresholds with standard deductions. And that's beyond what I want to get into right now. The point, though, is that if you were 68 and taking IRA distribution, you can't do that because part of the rules with that particular thing is you got to be 70. It's just how it is, right? So it depends, in that case, it depends on your age and it depends on if you're charitably minded. It's not worth doing in order to avoid taxes if you weren't going to give to charity anyway, because you're only going to get a percentage based on your marginal bracket. All these different things go into how it depends. Fact and circumstances have to be analyzed for every situation. We do have one question in the chat where it doesn't depend. Somebody's asking about the BOI updates. Okay. So the soap opera that is the BOI report continues. Okay. For those who don't know, in 2022, I think it was, I've already lost track, there was one of these massive 1,000-page laws that was passed. Inside of that was the text of another law that didn't pass called the Corporate Transparency Act. And in the Corporate Transparency Act, it created this whole regulatory framework of people who have entities, like LLCs, for example, that are registered with secretaries of state that would then have to report information to the federal government. And this became called the Beneficial Ownership Information Report, BOI. And what the BOI report says is there's company X, here's the name of the company, here's the address and all this kind of stuff. And then you're going to list everybody who has a 25% or more beneficial ownership. So whether you're a direct owner or you're an indirect owner or an indirect beneficiary, then you would be on this list, right? And you have to upload that person's name, address, you got to upload a copy of your driver's license or whatever. So there's no fees, there's no taxes. They just want your information. Personally, this aggravates me to no end because, oh, did I lose you guys? Am I still here?
No, you're still here.
Okay, you froze. All right. So this irritates me to no end because this is just duplicate work that the government already has, right? So what in the text of the law, they say it's to combat money laundering and to combat financing of terrorism. So that's all well and good, but keep saying when something's free, you're the product. That's absolutely true. If you have an entity with a Secretary of State, then obviously that Secretary of State has that information because that's what it's from. If you upload a driver's license or a passport or something, that's from a government agency, right? Whether it's the federal government with a passport or whether it's the state agency for your getting a driver's license, the entity itself will show up somewhere on a tax return. So the IRS has information. And so the feds just want your info in one tiny little place so they don't have to go through the trouble of asking this agency or that agency. It's total nonsense. And there have been lawsuits about this, and there have been a couple lawsuits at this point. So lawsuit number 1 was back in March of 24, and they said, the judge in that case, it was in federal court, the judge said unconstitutional, period, full stop. And the Treasury Department, which is the agency that runs this particular program, their response was, okay, so this, and the suit was brought by a trade association of 50,000 businesses. There's 10 million small businesses in America. So 50,000. So the Treasury said, okay, we won't enforce this against this 50,000 member group. I said, that's not really what unconstitutional means. Unconstitutional means you can't do it just at all, period. But they said, yeah, we don't care. We're still gonna enforce this. And so lawsuit that went in November. And in this lawsuit, the judge, again in federal court, the judge said that this is likely unconstitutional and therefore is going to grant a temporary injunction, and meaning that the government was not allowed to enforce anything. So over the last 2 weeks, over Christmas break, there was a whole bunch of back and forth. And so what ended up happening was that there was an appellate court decision in, I think it was the day before Christmas or maybe 2 days before Christmas. And they said, okay, we're going to stay the temporary injunction. So enforcement is back on. The day after Christmas, another court said, no, can't do that. The injunction is back in force. You cannot enforce. And then on the 31st, last day of the year, the Treasury appealed to the Supreme Court for an emergency relief, saying, can you make a decision real quick so we can start enforcement? And the Supreme Court they declined to hear the emergency appeal. So the Supreme Court just said, deal with your own stuff. We're not going to take a stand right this second. And so at the moment, there is no beneficial ownership information report requirement. And in fact, if you go to FinCEN, fincen.gov, last time I looked a couple days ago, this was still in force. So if you go over here, oh no, we don't want the news report. We want BOI. Okay. Alert, ongoing litigation. Voluntary submissions. Okay. At the moment, you can submit a report. It's voluntary. They can't enforce it. There's no penalties. There's no nothing because it doesn't exist. But if you want to give them your information, you can. So that's where we are right now. And obviously, this is an ongoing thing that has been back and forth. I've got lots of blog posts on the subject. Way back when, I made a video of actually how to fill out the form if you want to do it. It's not terribly hard. And I've seen places charging like $500 to fill this out for you. You don't need to spend $500. $100, man. Okay, I can understand that. We at Tax Sherpa, I made the strategic decision that we're not going to be doing this. So if you want to do this, you can. I recommend you talk to your lawyer about it because this is a legal thing, not a tax thing. And there was some confusion as to whether this counts as practicing law or not, and I just don't want to get to it. It's not necessary. It's not required by law at the moment. So that's the update. All right. So I get a little worked up about it because it's such a ridiculous overreach. Anyway, so that's the update on BOI stuff. Not required. I'm not advising you any which way, but talk to your attorney, and the bottom line is not required for now. And if that changes, we'll let you know. All right. Sarita, what else do we have on the list? So we've been out for winter break, Christmas break, New Year's, all that kind of stuff. So I'm sure we have a lot of things that have piled up. We've only got a half hour or so left. So what do we have on the list?
So we have a general S Corp question. Client wants to know, how do I pay myself with an S Corp and how does it save me money?
Right. Actually, over the break for our navigators group, which is our premium, we actually had a S Corp workshop where I went through this whole thing at great length. But basically, the S Corp is an election. It's a tax filing where the company is going to file its own tax return of a special type, 1120S. And the difference is that when you have a net profit from an S corporation, that's going to pass through to the owner. So if I'm the owner of an S corp, I'm still going to pay my personal income tax on my total income, including the profit from this S corp. What changes, though, is that the profit is not subject to self-employment tax, which is the Social Security Medicare tax replacement. So if I have a sole proprietorship where I'm just operating myself as a business, or if I have a partnership, I do pay self-employment tax on whatever that amount is. So if I make $100,000 net profit, that's 15 grand with the self-employment tax if I'm a sole proprietor or if I'm a partner, but it's zero of self-employment tax if I'm an S corp owner. Okay, so that's a 15% difference, and that's huge, and it's just a big number. We see a lot of small business people who are paying more in self-employment tax than they are in income tax. Now it all gets included when you file your tax return. You end up with one number, but self-employment tax is one assessment, and then the income tax is a different assessment. Then they get added together. S corporation, the advantage is that you don't pay self-employment tax. However, Congress knows this, right? And so there's this reasonable compensation rule. And I spent 30 minutes on the workshop talking about reasonable compensation. But basically, you're supposed to pay yourself a reasonable amount for the work that you do for the company. And that payment is going to go through a regular W-2, just like if you were employed with a company you didn't own. And on that payroll, on that W-2 portion, you are going to pay payroll tax. You're going to pay Social Security and you're going to pay Medicare. So that's the clawback that the government has in order to get at least something out of you. Whereas the remainder is going to be net profit that is not subject to that self-employment tax. So that's how you do it. You just set up a payroll, and like with our clients, I think all of them at this point are all. We just set it up through QuickBooks Online. They are our preferred provider for that function. Usually, if we're also doing the bookkeeping, then obviously that's all integrated, very easy. But there's a million platforms out there that'll do it. We've had trouble with a few. Gusto used to be great and cheap, and then a couple of years ago, their customer service just took a dive. So we don't recommend them anymore. QuickBooks Online has been very functional. We had one client that we inherited from this acquisition that was on ADP. ADP has been jamming us up as far as transitioning that, and we've been stuck for the last 2 months. So I'm not too happy with them, but there's a lot of them, right? And I really strongly recommend that you do not do it yourself. I have never seen anybody do their own payroll and not screw it up. Use a professional payroll service. And yes, it does cost money, but part of the price of doing business. You'll still end up saving on the tax thing. And how much do you pay yourself? It gets into that reasonable compensation discussion, which again, will take 30 minutes all by itself. But you want to be careful. A lot of people overpay themselves, which sounds surprising, but you want to be very mindful of what it is that you're actually doing, because as a small business owner, you're never just doing the thing you're selling, right? So if you are, I don't know, so let's say you sell chocolate, right? You're not just a chocolate salesperson, right? You're doing admin work, you're doing formula research, you're doing sales, you're doing marketing, you're doing collections, you're doing scouting different locations, you're doing all this other stuff to make the business work. And all those different things have different costs if you were to hire somebody else to do them. So that's what you want to think about when you're doing reasonable compensation analysis. And the company has to be able to afford it. So there's that. All right, Buzzkill saying, oh, on the BOI stuff, made the decision not to file, attorney listed pros and cons, ultimately came to the same conclusion. Yeah, that's good. And yeah, QBO is reasonably priced. I think it's like $50-$60 a month, that kind of thing. So it's not horrendous, and it works. So there's that. Yeah, so that's how you do it. You just set up a W-2 and then just go from there. There's a lot of math that goes into what the W-2 should be, though.
And that's like a whole nother different topic.
Yeah, beyond the reasonable comp, there's also QBI optimization and other things. So I don't want to get lost in the weeds too much this early in the year. So let's move on to the next question.
Okay, so we have a real estate question. So a client wants to know, what are the tax rules for renting out my Florida property while I'm stationed in Texas?
Yeah, it's just a regular rental. So the rules are, so some people get confused. Whatever your revenue is, you got to report it. Okay, so that's rule number one, right? All U.S. taxpayers have to report all worldwide income. So you said stationed, so it might be a military person, right? So even if you are stationed overseas, you still have income that you have to report, even if you're overseas. Now, if you might have like non-taxable combat pay, and that's a whole thing. But in the U.S., you're required to report income from all sources all over the world. And maybe you get a credit for something that happened overseas, maybe not, depending on the situation. For real estate, you're going to have your income, your revenue, however much rent you collected, and then you're going to have direct expenses. You're going to have maintenance, you're going to have utilities, you're going to have maybe advertising costs, maybe you pay a manager, all these kinds of things. Real estate taxes are always something. Maybe you have HOA dues, maybe you don't. Florida, you probably do. The two things that are indirect a little bit are mortgage payments. So a lot of people say, I rent it out for $1,800 a month, but my mortgage is $1,200, and then I have some utilities. So I only clear like $50 a month, $100 a month, not so fast. When you took out a loan in the mortgage, you received, whether it went to you directly or went to the closing attorney and it never went into your pocket directly, you still received the benefit of a huge amount of money in the form of that loan. And that was not income to you because it was a loan. Likewise, on the payment side, when you pay back that loan, the principal is not an expense. Okay, the loan coming in, not income. The payment back, not a deduction. What is a deduction is the interest. depending on your particular loan, where you are in your loan life cycle and all those kinds of things, the interest is going to vary. When you say I've got a mortgage payment of $1,200, it's okay, but how much of that is interest? And that's the part that's actually deductible. Now, the other thing that's not direct is depreciation. Any real estate property, if you own it, you're going to have depreciation, even if, whether you have a condo, whether you have a mobile home, whether you have a 10,000 square foot apartment building. Depreciation is a write-off of the wear and tear of the property. And depending on the numbers, then that can be significant or it might be minor. So we've had people come to us and says, oh yeah, I bought this house that I'm renting out and I got it super, super cheap. I bought it for 30 grand and I put 20 grand into it and I'm renting it for $1,200. I'm like, fantastic. You have next to no depreciation, which from a tax perspective is not as great. On the flip side, you might have a very high price property, which has enormous depreciation, and that's going to kick what you had in terms of cash flow, it's going to kick it into negative for tax purposes because of that depreciation. So most rental real estate that we see operates at a negative for tax purposes because of the depreciation. Now, when it comes to depreciation, there are strategies to apply, right? And again, I don't want to spend 30 minutes on the whole thing, but the basic rules are that for residential real estate, 27 years is the timeline. So you bought something for $270,000, you get 10 grand a year write off. For commercial property, it's 39 years. You can accelerate that by doing what's called cost segregation. And that's separating the property into different components like cabinetry and wiring and landscaping and all these other things. And those other things have a much shorter lifespan and they have much higher depreciation in the early years. And so you can maximize your depreciation expense through cost segregation. But there are caveats with that as far as who can take that, when, and how much is going to affect their other things, depending on the rest of the things that are going on in their tax world for that year. Whether it's short term or long term, whether you're materially participating, whether you're a real estate professional, all these kinds of things. How much other income you have, and all these. So these are all different factors that go into how you treat these things involving real estate for tax purposes. But fundamentally, worst case scenario, most rental real estate operates at a tax-free basis, meaning that the cash flow that you get is going to be tax-free. Best case scenario, you create a huge tax write-off against other income. So worst case, it's not going to hurt you. Best case, it's going to help you a lot. Real estate can be really powerful from a tax perspective because of that.
Oh.
That is my answer.
Okay. So we have owning a car question, right?
Owning a car?
Owning a car for a business that's not under the EIN. So does it make sense to transfer my car to the business for tax purposes, or how would that work out?
Usually not. In the cases where the car should be owned by the business is if you are using it exclusively for business purposes. We've got one client, he's a security company owner, and he's got 7 cars that are all wrapped with his graphics, and his employees use that to patrol neighborhoods. For that, car should be owned by the business. It's exclusively used for business purposes. If it's a mixed thing, then it's usually better to own it under your personal name and take reimbursements from the company. And you do that through an accountable plan. And basically you get reimbursed by the company for the business use that you put on your personal car. And that is way more flexible and gets you in way less trouble. Because if you do it the other way, then you have to back out the personal use amounts. And that can cause issues if you don't do that correctly. Also, your insurance is going to be higher if it's in a business name rather than a personal name, because business policies just cost more because you're doing more activity than a normal person. And if you have like a consulting company that you use your card for some business, some personal, just own it in your personal name, get reimbursements. If you are doing something where the vehicle is part of the business, then yeah, do it in the business side. And the great thing about doing the reimbursement way is that you can actually take much higher advantage of your car expenses than you can if you buy it directly through a business. Because on a business purchase of a vehicle, there are dollar limits of $20,000, let's say, I'm rounding here, of how much deduction you get in any one year. And then through reimbursement, you can step around that kind of limitation, which is nice. Comes in handy sometimes. But yeah, usually buy it in the personal name and then take reimbursements.
Okay, sounds good. And so we have another question for a high income earner. So the client wants to know, can investing in certain businesses or funds help high income earners save on taxes?
So there's every year we get people saying, wanting us to look at these different opportunities. So there are companies out there that market to high income people because they are accredited, and that being accredited allows you to invest in these private deals that the general public cannot. And so in order to incentivize those investments, a lot of them are structured in ways to create tax advantages. And there's a million different versions of this. So some of them are perfectly legitimate, some of them are on the aggressive side, some of them are outright fraud. So you got to be careful. So a few years ago, there was a whole bunch of conservation easement syndications going around. And so conservation easement is you take a piece of property, it's a market value of whatever, $5 million. And you say, okay, we're going to put this aside and we're going to put a conservation easement on this property, meaning it cannot be developed. And as a result of that, the market value drops enormously, which rightfully, and because you can't build on it, then what are you selling? You can go, so you take a basically a charitable deduction effectively of whatever that market value difference is. Now, this got onto what the IRS calls their dirty dozen list because they were being abused. Sometimes the conservation easements, the values that were being presented were aggressive. Sometimes the property didn't exist at all, right? It's just outright fraud. Okay, so you got to be careful with that kind of stuff. So there are different company strategies that are either passing along deductions that you might be able to use, they're either passing along credits that you might be able to use, or they are possibly recharacterizing some income. So those are the three basic buckets. And yeah, they do exist. The legitimate ones are legitimate, but there are a lot of people who play fast and loose that you got to be careful of. So yeah, it does work. And generally, your buy-in price, they'll do a presentation. And they'll say, okay, if you're in the 37% bracket and you get this and you get that, then you're gonna pay us $100,000, but you're gonna get 150 back on your taxes. And yeah, sometimes that works. You got to really be careful with the assumptions that they're making. And if those numbers in that model applies to you, then yeah, great, that might work. If you're in a slightly lower bracket, or if their strategy puts you into a lower bracket, then those numbers sometimes don't work out. So you got to be really thorough and model out what it is that they're offering and how that's going to affect your particular situation. Because again, it depends.
So definitely a depends question.
Yeah.
Okay. So we have a remote work question. Client wants to know, do I owe taxes on multiple states if I work remotely for a company based in a different state?
Sometimes. Depends on the states.
So it depends.
Yeah, it depends. Two giant pains in the ass with this particular question are California and New York. Other states are less, more or less, the other 48 states are easier to deal with. In California, they view the money coming from a California company being paid to you in wherever, Missouri, as California sourced income. And so they're going to treat that as you being involved in the state. In New York, for example, even if you're a W-2 employee in New York, the way they list their W-2s is that they display the full amount of your W-2 as being taxable in New York, and then you have to go back and file a tax return saying I'm a non-resident and your withholding isn't right and all this kind of stuff. So it's a giant pain. Yeah, it just depends on the two states involved. And if you're in a no income tax state, Nevada or Texas or Florida, then you don't have to worry about your home state, but you might have to worry about the source state. So it just varies. That's a real it depends question.
It depends, guys.
Yeah.
So we have an investment question. How are capital gains taxes different for a short-term and a long-term investment?
Yeah, in short term. So short term and long term is under or over a year. So if you hold the thing for under a year, it's short term. If it's over a year, it's long term. So short term is just taxed just like any other income. If you got a dividend or interest or whatever, it's just your ordinary income rate. So if you're in the 22% bracket and you have a short term capital gain, you're going to pay 22% on it. On long term gains, there's a lower bracket. And this is also true of qualified dividends. So long term gains, it's going to depend on your total income for the year and what bracket that places you in. And then rough numbers. If your total income for the year is 0 to 50K, your long-term tax your long-term capital gains are 0, and then above that it goes to 15%, and then above that it goes to 20%. And then there's also another potential tax that you might be paying called the net investment income tax of 3.8%, and that's an Obamacare tax that gets assessed on investment income if your income's high enough. So 0, 15, 20, 23.8 is the spread for long-term capital gains. Whatever the capital gains rate you're paying is for long-term, it's always going to be less than your ordinary rate, and roughly 2 to 1. So if you're in the 24% bracket for regular income, your capital gains rate's probably the 15% bracket. So that's something to keep in mind. I will tell you, long-term capital gains rate discount is not all it appears to be. And the reason is that this is one of the only places in the tax code where you are paying current dollars on old dollars. You have to take into account the inflation that you've paid for, quote unquote, paid for over the years that you've owned that asset. So if you put $100,000 into something in 2000 and you sold it for $150,000 in 2025, then okay, so that's a $50,000 nominal gain, and you're going to pay tax on the $50,000. But in real terms, in inflation adjusted terms, you probably have a loss that you're still paying taxes on. It's brutal. The long-term capital gains, again, depending on the situation, depending on the numbers, depending on the years involved, can be an infinite tax rate because you're actually paying tax on money that you lost in real terms, even though you gained in nominal terms. So it's slippery. And this is a point I've made more and more over the last year or so that people are really unaware of, because we only deal in nominal terms, right? So I bought it for 100, I'm selling it for 150, great. Well, what's that 100 worth from 20 years ago? Now, there have been proposals floated that they're going to allow for inflation adjustments on capital gains calculations. And if that were to come to pass, then that would be fantastic. But so far, it's just words, right? Nothing has passed. We've got a new administration coming in a couple of weeks, and there's all kinds of promises when it comes to tax legislation. So we'll see what happens. That would be something I would be super excited to see, because a lot of people rail against capital gains rates and they say it's unfair. You don't really, you're taking a very surface look. You're not looking at what's actually happening underneath. So I think inflation adjusting basis would be phenomenal for capital gains. But again, we'll see.
And so we have another real estate tax strategy question.
Yep.
How can a 1031 exchange help defer taxes when selling real estate?
Yeah, so a 1031 deferral is a like-kind exchange. This only applies to investment real estate, does not apply to your personal home. You can't live in it before or after, basically, whichever property it is. For investment real estate, you have something that has a lot of gain built into it. I bought that house for 100 grand 20 years ago. Now I'm selling it for 150. Great. I don't want to pay the tax on it. And so if I'm going to keep that money invested in the real estate market, then instead of taking the money from my personal lifestyle, I can roll it over into the next property. And if I do that, then the gain is deferred. So it's tax-free until I sell that second property. The way it works is you get a 1031 intermediary. You can't just decide to do this yourself. You have to have a third party hold the money for you and do the transaction. So you get a 1031 intermediary, and you sell property number 1, the money goes to the intermediary, and then you have basically three months to find the next property and another 3 months to close all the property. And you say, okay, the money you're holding for me, I want to spend on this property. And 1031 says, great, give me the lawyers or closing agents' information, and they handle all the flow of the funds. So as long as you roll over the entire amount, then it's totally tax-free to you. If you, and it doesn't have to be 100%. You can shave it any way you want. You can do full rollover, you can do a partial and pay tax on the amount that you take and all this kind of stuff. You can, totally up to you. Now, caveats with this is that this basically only works if you are buying something that is more expensive. You'll have to step up your way through the investment world, which is okay. And you can do it it doesn't have to be 1-to-1. It could be 1-to-3, it could be 1-to-5, it could be 1 to whatever, just depending on how the sales proceeds work for you. So the thing to keep in mind, though, is that your basis for the next property remains the same as the property you sold. So if I bought the place for 100 grand 20 years ago, and I'm buying the new place for 500 grand, my cost basis for when I sell that second property is the 100 grand on the first property. And A lot of people get confused by that because then when they go to sell that second property, they say, I bought it for 500 and now it's worth 600. That's $100,000 for the gains. So no, you did a 1031. You bought it for 100 and you sold it for 600. So now you have a $500,000 gain. And on the end of the cycle, people will roll over their money over and over again. And then they have this big portfolio if things went well, and their cost basis is effectively zero. And so they're like, people start to feel trapped and they start to say, if I sell now, I've got a huge tax problem. Well, not problem. I've got a huge tax bill. And I don't know if I really want to do that. And some people overextend themselves with financing and they actually don't have the cash to pay the taxes. That's a nightmare scenario that you don't want to be in. So the traditional plan is you do 1031s, you roll over, grow your real estate empire, and then you die. And your heirs pick up the property at the current market value for their basis. So the tax bill never comes as long as you die with the property. If you want to cash out, then the tax bill gets hit. So just things to be aware of when you're building your 1031 empire. Sometimes people reach 60, 70, and they're like, I don't really want to do this anymore. Well, you might have more trouble getting out than you expected.
Yeah. Yeah, that would be a long time, right? Especially if they started like in their 20s.
Yeah, it does
Oh,
happen though.
yeah, crazy. So we have a retiree question.
Okay.
Someone wants to know, are there tax benefits to moving to a retirement-friendly state?
Yeah. For sure. When people think about retirement states, they think about the state has no income tax, then that's going to be helpful. So federally, there's no, but the different states definitely have different rules. So if you go to a tax-free state, that's obviously going to be less tax taken out than wherever you're coming from. So we see a lot of people. So I used to work in South Florida. We saw a lot of people from New York, New Jersey, who were getting pension payments from like teachers and firefighters and police and all this kind of stuff. They have very generous pension programs. And then they move to Florida where there's no state income tax. It's like, oh, you're saving 10% on your maybe not 10, but whatever. You're saving a good chunk on your pension payouts. And there have actually been, I don't know, announcements by mayor's offices and governors and people from New York, New Jersey saying that this is unfair because, you know, that money was supposed to be taxed in New York, New Jersey to go back into the system for the current people. So the people who worked there all their lives, paid in, and are now getting benefits and take off, they are not continuing the cycle. And that's a major budgetary problem for them. So yeah, a lot of people do that. Now, just because your state has state income tax, a lot of states make allowances for retirement income. So Maryland, I think your first 30 grand, if I remember right, of retirement type income is tax free for state purposes. Georgia's pretty generous as far as their retirement benefits. You don't necessarily have to go to a tax-free state in order to get tax benefits for retirement income. And you can look on the lists. All these publications will compile lists of cost of living in retirement, and they'll rank different places. And I would say consult those because there's a lot that goes into it, right? There's weather, there's tax load, there's access to healthcare facilities, there's social groups, all these kind of things. And don't make a decision just based on the taxes, but that should be part of your overall decision as far as what you want to do in retirement. But yeah, or build the real estate empire. It doesn't matter where you're right? As long as you have cash flow coming in.
Looks like we have a charitable giving question.
All right. This will be the last one for today, but yeah.
Okay. All righty. So a client wants to know, what's the smartest way to give to charity and maximize my tax deductions?
That's a good question. And I hate to say it depends, but most people are not able to use charitable contributions anymore. So this was a change that came from the Tax Gun Jobs Act, which is Trump's tax reform back in 2017. And what happened there was that before the 17 reform, you had exemptions, which was a deduction based on your family size. So it was like $4,000 a person, let's say. And then you had a standard deduction, and that was based on whether you were a single head of household or married. And the standard deduction was a reasonable amount. So basically, if you had a mortgage and property taxes, then basically you itemized and you exceeded the standard deduction. And then in that scenario, any charitable contribution you made was increasing your already itemized deductions, and you were able to get full deduction for that amount. And that lowered your taxable income and that lowered your taxes, which worked great. 17 rolls around, Tax Gun Jobs Act comes in. They got rid of exemptions and they doubled the standard deductions. So if you had a big family, you were actually hurt by the change. If you had a small family, you were helped. So under the standard deduction, so like this year, 2025, if you're a married filing joint couple, your standard deduction is $30,000. In order to get the benefit of charitable contributions, you have to exceed all your itemized deductions together have to exceed $30,000 before they start changing your tax bill at all. You can do that if you have enormous medical expenses, or you have an enormously expensive mortgage, or you give a whole lot of money to charity, and or you have some combination of that, right? So for most people, that is no longer doable, right? So the vast majority of people these days, you just use the standard deduction. So like I was talking to that same couple we talked about this the other day. So they were in, and so they were asking that same questions. What if we gave money to charity? And we looked at their tax returns and said, well, you don't have a mortgage, you do have property taxes, and your medical expenses aren't that high. Basically, you would have to give $20,000 to charity before it started shifting your tax bill at all. And for most people, that's just a non-starter. If you have very high income and you give like a full 10% tithe, that kind of thing, then you might reach that. I've seen people give six figures to charity for sure. And in that case, yeah, it'll help. But for the majority, this doesn't do much these days. Where it can help for the retired people, like we talked about earlier, is the QCD, qualified charitable distribution. That can help directly because of the same standard deduction issue. But if you're not in that situation, you're not over 70, then unless you're giving huge amounts, probably not going to make a difference. But always run the numbers. Like whenever we're doing a tax return, we'll always calculate whatever the itemized would be, and we'll take the itemized if it makes sense, but usually doesn't. So that is how to take advantage of charitable. Now, I will say, if you're a high income earner, there are, again, like we talked about earlier, there are these companies out there that will create charitable deductions for you. So that is a potential option, but that's six-figure deals, so not applicable to most people. Okay, so that brings us pretty close to the hour, and that's all my it depends for now. I have one last it depends. If you're not already, so that's the it depends. If you're not already either a navigator or an explorer, join the explorers group, and you'll get notifications about calls like this. You can submit questions. You can be notified about workshops and things like this. So the S Corp workshop, for example, that was for our navigators. That's our premium group, and it will be available once I've finished uploading it and everything. It will be available to explorers for a fee. Now, I'll let you in on a little secret. For any of this stuff, there's a bunch of free courses and tools and things that are available for explorers. So what I was working on today was S Corporation elections. So I spent all day on this. I'm still not done. But basically, there's a form to fill out, and people get terribly confused by this form. So what I'm doing is I'm creating a tool to fill out the form for you. You just have to put in the information in a much easier to understand way. And that will be available to all of our explorers as a freebie. There's an AI bookkeeping solution in there. There is a partnership, an ebook that I wrote about the 13 questions you have to answer with your partner before starting business, so you don't blow yourself up, basically. But there are also things that are paid opportunities in the explorers group. But I'll tell you the secret. The secret is, if you want to do any of the paid things in the explorers group, just join the navigators, because you get all this for free and it's cheaper, which is not an accident. But if you're new to Tax Sherpa, just join the explorers group. You'll get emails like the beneficial ownership information. I sent out an email about that 2 weeks ago when I updated the last blog post. I got to send another update because of all the things that happened over Christmas break. And then we'll talk about ongoing issues and things like that, whether you're one of our clients or not. These are just applies to everybody sort of stuff. So one thing that I'll be writing about here shortly is just like all the dates, right? So there's the January 31st date, there's a January 15th date, there's a March 15th, there's an April 15th, and all these kind of things. And what has to be done when and for who and all this kind of stuff. Just helpful information. I hope to see everybody in the Explorers group. And yeah, it's free, so might as well. All right, so that brings us to the end of the hour. I hope everybody was able to see how it depends. And we do this every week, except for Christmas break. But we'll do it again next time. So next week is the, 14th? Something like that? Yes, 14th, 6 p.m. Eastern. And we will do it again and keep trying to save America $1 trillion. And hopefully I'll have my S Corporation election form tool done by then, and that'll be just another arrow in the quiver as far as saving people tons of money. All right. We'll catch you guys next time. Have a good one.
Alrighty.